All right, let's talk about one of the most powerful and honestly one of the most misunderstood forces in our economy, inflation. Today, we're going to break it all down. What it is, who it hurts, who it actually helps, and most importantly, what it means for your wallet. Let's dive right in.
So, what's the deal with inflation, really? Is it just that your grocery bill keeps getting higher, or is it something much, much bigger? A fundamental force that's actively reshaping markets, government policy, and your own personal wealth. In this briefing, we're going to dissect the core problem, trace its ripple effects, and build a framework so you can navigate its impact. By the end, you'll see exactly who wins and who loses.
At its absolute core, inflation is pretty simple. Prices for everything are going up. But the real kicker, the effect that matters most, is that it systematically reduces the purchasing power of your money. You know, $1 in your pocket today just won't buy you as much tomorrow. This slow, steady erosion is the foundational problem that affects every single economic decision out there.
So where does high inflation even come from? Well, it isn't random. It's driven by some really powerful forces. First, you've got classic supply and demand. Basically, too much money chasing too few goods. Second, you get supply shocks. Think about the global energy crisis after the invasion of Ukraine. Just massive disruptions. And third, and this one's fascinating, is the psychological part, inflation expectations. When we all expect prices to rise, we demand higher wages. In response, businesses raise their prices, and suddenly you're in this dangerous, self-fulfilling cycle.
Okay, with that foundation set, let's bring this down to a personal level. Because before inflation is some big macroeconomic concept, it's a kitchen table issue. You could really call it a tale of two wallets.
And this really captures just how unequal inflation is. For lower-income families, it's a direct assault on their budget. A huge percentage of their money goes to necessities. We're talking food, gas, rent, things you just can't cut back on easily when prices spike. They have a much smaller financial cushion. On the flip side, higher-income households spend a way smaller fraction of their income on those same things. But even more important, they're much more likely to own the very assets, like real estate, that can act as a shield, or in some cases even a booster rocket during inflationary times.
This quote just nails it. You know, when you hear policymakers talk about core inflation, they've often stripped out volatile stuff like food and energy prices. But that completely misses the reality for millions of people. For anyone living paycheck to paycheck, food and energy are the core of their budget. So while a 2% inflation rate might be the official target, a 10% jump in gas prices is a real immediate crisis for that family.
And the pain doesn't stop with spending. It actually punishes you for being prudent. If you're a diligent saver with cash sitting in the bank, inflation is silently eating away at its value, day after day. For retirees, it's a huge threat. A lot of them rely on fixed incomes. And sure, some things like Social Security have cost of living adjustments, but they often lag way behind the true rise in costs, especially when inflation is high. The direct result? Your entire financial plan gets thrown into chaos. That nest egg you thought was enough for a comfortable retirement, suddenly it might not be.
Okay, let's zoom out a bit. We've seen how it hits individuals. Now let's get into the broader macroeconomic picture. This is where central bankers have to perform a very delicate and often pretty thankless balancing act. You hear this number all the time, 2%. That's the magic number, the target inflation rate for the US Federal Reserve and a bunch of other central banks. But have you ever stopped to wonder, why not 0? I mean, why would they actually want prices to rise at all? The answer is that a little bit of inflation acts as a critical buffer against something that's way more dangerous for an economy, deflation. And here you can see the two devils side by side. Moderate inflation, that 2% target, it actually kind of greases the wheels of the economy. It gives you a little nudge to spend or invest your money today rather than just hoarding it, since you know it'll be worth a tiny bit less tomorrow. Deflation, on the other hand, well, that's economic poison. When prices are falling, everyone delays buying things because they think, hey, it'll be cheaper next month. That causes incomes to fall, and crucially, it makes the real burden of your debt go up. Your mortgage payment stays the same, but the money you earn to pay it is shrinking. That can lead to mass defaults and a full-blown banking crisis. So policymakers see moderate inflation as the devil they know and the one they can manage.
And if you want to see the nightmare scenario of what happens when inflation expectations get out of control, you just have to look at the 1970s. It's the ultimate cautionary tale. People started expecting high inflation, so they demanded higher wages. Businesses, in turn, jacked up prices, and the cycle just spun faster and faster. By 1980, U.S. inflation was screaming past 13%. To break the fever, the Fed had to raise interest rates to absolutely punishing levels.
The medicine worked, sure, but the side effect was a deep, painful recession that sent unemployment over 10%. That history is burned into the memory of every central banker alive. It's why they get so aggressive the second they fear expectations are becoming unanchored.
So that brings us to our third level of analysis. If inflation reshapes the entire economy, how does it reshape the landscape for your money? This is the strategic part of our briefing, really understanding the impact on assets and on debt.
All right, now for one of the most counterintuitive ideas in all of finance. In an inflationary world, debt can actually be your best friend, but specifically fixed-rate debt. Think about a 30-year mortgage. You've locked in your payment. As inflation chugs along, your wages and income will hopefully rise over time, but that mortgage payment stays exactly the same. You are, in effect, repaying your loan with future dollars that are worth less than the ones you borrowed. The real value of your debt is actually shrinking.
So here's the strategic playbook laid out. As we just saw, borrowers with fixed-rate debt come out ahead. But assets that give you fixed payments, like bonds, get hammered. Their steady interest payments just buy less and less. The same can often be true for growth stocks, because their big, far-off future profits are worth less in today's money when inflation is high. So where are the winners? Well, you look to real assets. Real estate can be great, because rents can rise while your mortgage stays fixed. And commodities, like energy, often do well because their rising price is a big part of what's driving the inflation in the first place.
Okay, we've covered the what, the why, the impact on people, the big economic picture, and the strategy for your assets. Let's pull this all together and look at the final balance sheet. Who really wins and who really loses?
So if you take away one thing, it should be this. Inflation is not a neutral force. It's a massive, silent transfer of wealth. The winners are people who owe long-term fixed debt and own real, tangible assets whose prices can go up. The classic example is a homeowner with a fixed-rate mortgage. The losers are the ones who save in cash and those who rely on fixed payments. That's your retirees, bond investors, and lenders. And as we saw right at the beginning, the people hit hardest are almost always low-income households, who are the most exposed and have the fewest ways to protect themselves.
And that brings us to our final, and I think most provocative question. We've seen that a little bit of inflation is actively targeted by policymakers to avoid the bigger evil of deflation. We've also seen that it systematically benefits debtors at the expense of savers. It literally transfers wealth. So, knowing all that, should we view inflation as just a bug in the system, a flaw that we need to crush? Or is it to some extent an intentional feature, a tool used to manage economic cycles, even if it comes with these deeply unequal consequences? That's something we're thinking about.